To the point of the day, Scentre Group is the stock of the day. It owns the Westfield shopping centres here in Australia. Full year funds from operations jumped 21% to just over $1.1 billion, or 20 cents per security, exceeding guidance. The group lifted its distribution to 15.75 cents per security. It completed a record 3,409 lease deals during the year, which is an increase of 912 on the previous year. On the outlook, it expects funds from operations in the range of 20.7 cents to 21.25 cents per security for 2023. And as I mentioned, the share price right now is up by 3%. So we are very pleased to welcome to the program the CEO of Scentre Group, Elliott Rusanow. Hi, Elliott. So nice to see you there. Thanks for joining us on the call. How did you beat guidance? How did that happen in a year that has been, well, at least marked by a lot of commentary about a slowing consumer?
Well, thank you for having me on the program today. If we rewind the clock back 12 months, we were in an environment where it was very difficult to provide guidance. There was a wave of Omicron, and what we saw during the course of last year was our deliberate strategy to drive visitation, which increased to 480 million people through 2022, an increase of 67 million people in the prior year. We were able to provide the opportunity for our business partners to interact with those customers, and they in turn generated some $26.7 billion of sales, which is a record for Westfield as a brand in Australia and New Zealand. And on the back of that, momentum built through the course of the year, and we were able to achieve what is a great result for 2022. And more importantly, we were able to guide for further growth in 2023.
How is that going to happen? We may as well go there right off the top. When we're talking about a slowing consumer, when we're talking about a mortgage cliff coming, when we're talking about people having to deal with the rising cost of living, why are they going to keep going to the centres to spend?
Well, there are many factors that drive consumer behaviour. Yes, there are rising interest rates, there are cost of living pressures, but also importantly, the level of employment remains very high. Wages continue to grow, and the Australian household has saved a lot of money over the course of the pandemic period. In fact, some $360 billion of additional savings have been accumulated since the start of 2020. And in fact, the savings ratio continues to be positive. And so what we're seeing in our business in the first 7 weeks of this year, at least, is 70 million customer visits, which is 10 million more than the same period in 2022. Our business partners in January achieved sales that were 21% higher than in the same period of January 2022, and importantly, 11% higher than in 2019. So our focus is to continue to drive visitation, to continue to drive giving people a reason to come to our centres. Today, we announced a collaboration with Disney to help them celebrate their 100th anniversary through in-centre activations and events. Again, giving people a reason to spend their time with us. It's free to spend time at the Westfield destination, but that provides the opportunity for businesses to interact with those people, and they did so in 2022, and they're doing so in January of this year, and we expect that to continue through the course of this year.
And also, do you expect that the return of international visitors could be good, the return of migrants could be good for the shopping centres? I mean, I would think that international tourists, particularly Chinese tourists, if they return in any large numbers, would serve and speaks to the market that you serve well.
Yeah, absolutely. I think that the important part is that migration is population growth is a driver of our business, and whether that's through tourists or whether that's through people who are coming here to permanently settle, whether that's through population growth. The important thing is that as populations do grow, that provides a greater opportunity for us to have those people come and spend their time with us, which is our strategic focus.
Now, as a former CFO, you know the balance sheet very well. Liquidity is very good. What about sort of the cost of debt in this rising interest rate environment?
Yeah, so as you said there, our liquidity is $4.8 billion. It's enough to cover all our debt maturities through to the fourth quarter of 2025. So from a liquidity, from a balance sheet standpoint, we're in a really strong position. We took the opportunity during the course of 22 to increase our level of interest rate hedging. The first 6 months of 22, we were fairly lowly hedged, so we took advantage of very low interest rates as a in our earnings. But we pivoted on that at the half year to increase dramatically our level of hedging, and so we enter into 2023 with 85% interest rate hedging, and we're pretty well protected from a rise in interest rates through that level of hedging. Notwithstanding that, we have provided the guidance, but within the guidance where we are forecasting that our interest cost will increase from 4.8% to 5.6%. So we have factored in an increase in interest costs and interest rates, but we are fairly well protected from a volatility standpoint as a result of those hedges that we entered into during the middle half of last year.
Okay, only in the interest of time, I do believe that between 60 and 70% of your rental income is linked to CPI. Is that around correct?
About 80%.
Okay, 80%. All right. And when you think about what's to come, so you have provided this guidance, barring no material change in the broader macroeconomic scene. They always come with that caveat, I suppose. But what is the next potential catalyst for shareholders? I mean, if we're thinking about the share price, where there's potential gain for shareholders, what might that be?
Well, I think if you think about the fundamentals of our business, we have very large fixed assets located in close proximity to 20 million people that operate in essence for limited hours of the day. And our focus is how do we effectively have those destinations really activated 24 hours a day. And the better we can do that, then we'll be providing more opportunity for businesses in a broader sense to interact with people. And that for us is a great avenue of future growth because we already have the infrastructure in place. Our task is to now have it activated for people to spend time at for a longer period of time.
Got it. Elliot, thank you so much for joining us on Ausbiz. We always appreciate your time on Results Day.
Thank you.
So you have Scentre Group there, Elliot Rossinow. We think we're busy when reports are coming through, but how about all these CEOs? They do a lot of talking on the day. Let's go back to my guests, Andrew Wielandt from DP Wealth Advisory, Henry Jennings from Marcus Today. Henry, just a quick thought on a Scentre Group. I mean, is this a buy, hold, sell? This is the stock of the day.
Well, it's definitely a hold. It's probably a bit of a nibble on a buy. It's pretty impressive. I guess the thing that shines through is the power of the brand in terms of Westfield and the mere fact that they've got sort of record lease signings, those visitations. It's become a destination, and this is obviously what they're pushing. And, when times get tough, retailers really flock to quality, and I guess this is the quality super, this is the quality super centre, I guess, the quality shopping mall, with reasons to go there apart from shopping. And of course, once you're there, it's very tempting to go shopping. So definitely a hold. Probably, given the level of hedging, given the level of CPI protection through those rental increases, it's verging on a buy. And I suspect we'll see some upgrades coming. The guidance was better. They did beat. And I think we're just showing the quality of the business shine through at the moment. And when times get tough, I think that's very important.
Well, my local Westfield it's a nice shopping mall to visit as far as shopping malls goes. So, Andrew, any thoughts on a Scentre Group? Would you be buying, holding, or selling on the basis of this result coming through? And the outlook, of course.
Yeah, look, it's definitely a hold, and the whole REIT sector, the listed property trusts, has certainly been beaten up. So definitely wouldn't be a sell. And as my learned friend, the professor says, quality begets quality. So certainly I think it's a hold. Whether it's a buy or not, I'm not quite sure yet. I'd like to see bond yields start to come back off. I think that'll give me confidence relating to REITs. Is it the buy of the day? No, we'll keep the viewers and listeners in bated breath, but this is not it.
All right. Well,